Hi, and welcome back to another edition of Know Before You Owe. Today, I've got a special guest on, Sanjay Kuttemperoor, and he is with Steadworth. Welcome, Sanjay.
Hey, Jim. How are you?
I'm doing great. Thanks for coming on our show. And you have a really cool product for a lot of first-time and any buyer that's looking to leverage different types of ways to get wealth through real estate. Can you share with us a little bit more about Steadworth and what the program is all about?
Yeah. Look, I think everybody understands what the narrative today is around housing affordability, right? I mean, you've got credit-worthy middle-class families that have good income that just can't afford to be in a home because at the end of the month, they're house poor or they just can't meet that monthly nut in terms of what it takes to service a mortgage when you consider all the macroeconomic factors such as obviously no home inventory, which results in home prices sort of, skyrocketing, slow wage growth, rents are escalating. So all these factors together make it very hard to save up enough money to come up with what is traditionally the 20% down payment on a home. And so most first-time home buyers, even mover-upper home buyers, are only able to put down 6 or 7% on the purchase price of the home. And what that means is they have to, pay for private mortgage insurance. And if you're at a 90 or 95% loan, and with the interest rates being as high as they are, your monthly payment is going to be a lot higher. And, quite honestly, many middle-class families just can't afford that monthly nut. So our thesis with Steadworth is that if you can get these families to a 20% down payment, you get them to a monthly mortgage payment that is much more sort of sustainable from a financial standpoint. Sorry, I said 20% payment. I meant 20% down payment. And so what we do at Steadworth is, we've come up with a program through which we will provide buyers with 10 or 15% of the purchase price of the home. They have to have some skin in the game with at least 5% or up to 10%. And together, they're able to get a 20% down payment. In exchange for our co-investing with that home buyer, we share in the appreciation with that home buyer for a fixed period of time. And it's just the appreciation. So the home buyer benefits from all the equity that is earned through paying down the mortgage. And once again, it's only for a fixed term, either 5 or 7 years. After that, all of the appreciation sort of accrues to the home buyer. They pay us our original investment back and whatever share of appreciation they agreed to up front. And that's sort of the solution at a high level.
Wow. So you're telling me for our audience that consumers could be basically leveraging a shared appreciation model to have a lower cost to borrow and a lower payment, which might mean other alternative ways to save money or maybe pay other debt off, or maybe they have a student loan or a credit card debt, or they want to save for their 401k or their kids' college savings plan. You can leverage the home equity based upon that. And then if I'm hearing you correctly, you're saying that you can also then you're only sharing in the true appreciation of the home. So it's really like no harm, no foul, or hey, if the homeowner wins, you guys also win. Is that a safe assumption?
Yeah, 100%. So, if our home is $500,000 and we help with the purchase, and the home buyer is able to come up with $25,000 and we come up with $75,000, they go get a loan for $400,000. Obviously, the monthly payment on a $400,000 loan is a lot lower than a $475,000 loan. So there's a lot of extra money every month that accrues to the home buyer that they can use for all of the things you mentioned: school, saving for college, whatever, trips, entertainment, just daily living expenses. So we help them get to that position where they're saving money every month. And
wow, that's huge. That's huge.
Yeah.
Cool. Can I share my screen right now and just show more about the product? Because I think it'd be great for our consumers to see how it actually works. So here is the website, Steadworth, and you will see Sanjay mentioned that there are different plans. Again, Sanjay, if you can walk us through, you said that there was a 5-year plan of allowing Steadworth to participate and a 7-year plan, correct?
Correct. So we've got basically 4 plans. with two different variables: the length of term of the contract that the home buyer enters into with us, either 5 or 7 years, and the amount of additional down payment monies they need from us, either 10% of the purchase price or 15% of the purchase price. And our share of the appreciation varies depending on the size of the plan. The smallest plan being the 5-year, only 10% needed from us, it has the least amount of appreciation sharing to us. And the largest plan, which is a 7-year, 15% plan, is the one where we take a greater percentage of the appreciation. Obviously, that makes sense, right? If we're going to give them more time and more money, we should sort of get a greater sort of share of the appreciation.
Absolutely. And I'm looking at your website. It's really slick. It looks like I can know all the variables. So in this example, $500,000 is the purchase price. Let's use the 5-year plan using 15% down payment. That sounds pretty awesome because I have less down payment, or I want to keep more reserves. Maybe I want to do some improvements on the property. Maybe I want to add an ADU. Maybe I want to do something like that. What's really slick about this is in your product, you can actually change the variables. Today's are about 6%. The PMI cost, for those who don't know, is private mortgage insurance, which is the premium lenders charge consumers to have a higher loan to value or a higher risk on their loan. And the last category is home appreciation. So if I thought that was less or more, looks like I could toggle these different variables. I'd imagine on average, it's about 4% in the country. And then I'm able to see kind of the overall plan before I even write any offers or decide to even buy a house, which is really powerful.
Yeah.
So here again, we got the contract term being 5 years, which is 5% of the down and 5% of the down payment. I, as a consumer, am bringing in $25,000. Steadworth is bringing in $75,000. And that also means then that I get about 44% of the wealth share or the appreciation, and Steadworth gets about 56%. And again, like you mentioned, this is the most extreme example because it's the most down payment you guys are letting someone leverage, which is pretty exciting. And this is awesome. I mean, this just shows, again, an example, right? Can you explain this a little bit, if you don't mind? Be awesome.
Yeah, I mean, what we try to do is, this tool really, focuses on consumer education, right? I mean, we want to make sure that consumers understand what it is that they're getting into in terms of their obligations. And, it's very important to us that they understand all the numbers, how the different plans work. And what you're showing here is just sort of our comparison between the monthly costs on a $475,000 loan, which is the scenario where they would only bring 5% to the table, versus a $400,000 loan, which is a scenario where we're bringing in an additional $75,000 to the table. And you can see the monthly mortgage payment is significantly less, right? And then obviously, because they're at 20%, there is no private mortgage insurance. And so at the bottom, we show them that, under this plan, they're saving $746.54 every month. And that's a significant amount of money that, they can use toward other expenditures. And as you sort of scroll down the page here, we show them what the total amount of interest that they save over the life of the contract, the 5-year contract, show them what they save in PMI. So, total of $28,000 saved through both interest and PMI. And then, we run the scenario of, okay, assuming the home appreciates 4%, this is the total appreciation, $108,000. And, based on the plan that they have selected, they keep $47,000 and we keep $27,000. So the total value created is $75,000, which is their share of the appreciation, together with what they've saved in interest payments and PMI.
This is huge. I love it. Right? On one page, you can see it transparently. There are so many state programs out there that are confusing. They're not specific to me as a consumer. And so I love this because it shows all those details. It shows even if I sold the property, what I would be getting in proceeds, it looks like, which is pretty powerful too. That's awesome. Very cool.
In the future scenario, we show them sort of in the sales scenario, if at 4% a year at 500,000, it appreciates to 608. They pay off the remaining mortgage balance. There's the proceeds. and it shows the payments that come to us, and then what they get, $98,000. That's wealth that we've helped them create because we got them into the home day one. And
Wow, it's huge.
then we also show them what happens in a refinance situation based on the appreciation. Now, this is based on a 4% appreciation, but if you toggle that to 5%, you can see how the numbers change.
Wow, that's really cool.
Yeah.
I love that it's dynamic and it can show me any scenario in a matter of seconds by changing the variables myself as a consumer. That's really cool.
Right. And then we also show them the future monthly payment of $3,060 if you scroll down. Now let's compare that to what their payment would be in the first year. If you go back to that first tab, Jim. Right here, you can see what the payments are.
Second one, I guess, right? There we go. Yep. Okay. So that would have been
It's about the same payment, right? Except they're kicking the can down the road 5 years, and they're basically in the home day one for about the same payment.
Wow, that's really powerful. We know the time value of money is really important to be aware of that. And what that means basically is you want to have extra funds today to make investments in things or pay down debt. So that way you're maximizing your ability to have the right type of debt, which is basically an appreciation loan in this case, where Steadworth only participates in the upside, which is only the equity from the time of the purchase price to the new home value. Is that correct?
Correct.
So again, if I pay down the loan by $100,000, Steadworth does not participate in my principal reductions, correct?
That's correct.
That's huge.
Correct. So
really cool.
The equity from loan paydowns accrues 100% to the home buyer, and we only share in the upside. And the other thing is we're also sharing in the downside risk too. So if the property actually goes down in value and they happen to sell their home, we don't get all of our initial investment back. So we share in that loss.
Wow. Very powerful.
We're true partners with the home buyer.
I'd imagine that new construction and builders should be really excited to use this project for some of their developments. I'd imagine if they believe in their communities that they're investing in and building, wouldn't that be a really good segment for Steadworth to be applied to?
Oh, yeah, 100%. I mean, I think that home builders, especially the larger ones, have been looking for ways to participate in the upside appreciation in homes that they built in their own communities. Just makes sense, right? They betting on themselves, right? And the value they create. And as you've probably seen, home builders are offering these mortgage rate buy downs as a way to continue to sell their products, their homes. But I could show you article after article that just states that those buy downs are costing the builder like 3 or 4% in margin, versus here just helping with some of that additional down payment, which is really just sort of leaving some of your profits on the table, and then participating in the future appreciation.
I love this. I love how detailed all the facts are too, the FAQs. So if you're a home owner or you're someone looking to buy a house, this should be something that you review with your lender, your local lender, to make sure that you can maybe have this as an option for you, because this to me seems like a fantastic way of allowing yourself to really leverage this really well. And it looks like you also have a property element here where I can search. Is this searching by properties too? Yeah. I can see why.
Yeah, the Steadworth platform has about 2 million active property listings on the platform. So people can actually search for homes, and right from each property listing, they could apply, pick a plan, and see how it kind of flows through.
Wow, huge. So specific to each property, to my own scenario, and then my own assumptions. Hey, I'm going to get 3% appreciation or 8% appreciation, but I get to choose those assumptions to determine what that looks like. That's powerful. Yeah, really cool stuff.
Exactly.
Awesome. And then again, to start now, there's a video. You just get started. It looks pretty cool and takes about 3 minutes. That's awesome. Yeah. Very cool. So this is exciting because a lot of, like you mentioned earlier, a lot of people don't understand the power of leveraging in a smart way, right? Some people take advantage of that and probably put themselves in a bad situation, but this seems to be a win-win, right? Steadworth wins when the consumer wins, or Steadworth also, if there was a down market or something happened to the negative side, Steadworth is absorbing their portion of that, which is also very powerful. So,
Yeah, I mean, we like to, constantly use the terminology, wealth creation, because if they're not in the home, they're not creating wealth. I think the National Real Association of Realtors did a study that, the average net worth of a person who rents is, $8,000 versus somebody that lives in a home is a couple $100,000, right? So it's
yeah.
the single biggest asset that you can own that creates sort of the greatest amount of wealth for a homeowner and their family.
So
So
cool. So cool.
to the extent that we can get them in and they're creating wealth, granted they're sharing some of it with us, but that's because we put them in a position where they could buy the home in the first place. It is truly a win-win.
And I've just thought about these other programs that are out there. We live in California, obviously, and there's a program called Cal HAFA, and they had a program called Dream for All. And I always called it Dream for Some or very few, because they have an allocated amount of opportunity. You have to be in a certain box. You can't make too much money. You can't make not enough money. You can't have too much assets. You can't have too few assets. And then you have a window of time to go find a property before the money runs out. And it's quite frustrating when these things are sponsored by taxpayers' money. It should be benefiting everybody, but unfortunately it's not. So just to recap, you can help anyone that qualifies with their lender. If I make $1 or $1,000,000 a year, it does not matter, correct?
Well, I mean, you have to have a good credit score. We require a 720 plus credit score.
Okay.
And you have to have, stable, steady income. I mean, we, sort of cap our sort of income DTI limits at about, 43 to 45%. So that there still is, enough cushion there. We don't want to put people in homes and, do it for a good reason of helping them build wealth, but still and put them in a situation where they continue to be strapped every month. So
Gotcha.
we do have certain limitations, but to your point, it's not just for first-time home buyers. It can be for anybody that sort of meets those sort of basic requirements. And as you mentioned Cal HAFA, I mean, as you know, those funds were like oversubscribed 20-1, right?
Yep.
And they had a lot of sort of restrictions. I mean, our programs, sort of solve, provide a solution for people that don't have the down payment, don't qualify for one reason or another for 99 or for 95% loan, or even if they did qualify, they don't want to be house poor every month, right? Because the payment on a 95% loan was too much. Or maybe they want to buy a little, because of the way the home prices are going, they want to buy a little nicer home. And because of the additional down payment monies we're giving them under this program, they could buy a little nicer home in the neighborhood they truly want. And then there's the other contingent of they'd rather use our money than sort of liquidate their investments, right?
That's huge. And then it looks like even for companies, like if I was having benefits at my company, it would be pretty awesome to offer this to my employees if I was to do so, right? Is that a whole other category that you guys offer?
Yeah, I mean, there's sort of the retail model, and now we're starting to align ourselves with different large companies that, want to, sort of figure out different ways for recruitment and retention, right? And everyone benefits, company benefits if their employees are sort of, well situated in a home in the community, right? That benefits the employee, it benefits the company. So I think there's a model through which companies are providing, through our process, additional down payment funds to home buyers.
So I could see someone, let's say we were trying to open a new facility in Sacramento, and I was competing against other companies for that matter. This would be a great fringe benefit to offer to help attract that employee to come work for us versus maybe another company. Maybe it's a hospital system or a school system or a big, huge corporation. This is a really good product that I could see companies also leveraging to really attract that talent. And like you mentioned, be invested in their community, which is really cool.
Yeah. I mean, and sure beats just sort of giving the money away, right? Like writing a bonus check, right? And, that's a cost. The company participates in something like this, they're making an investment into the employee, into their home, and then they also get a return on their money, right? So it allows them to create more opportunities for more employees down the road.
That's huge. So to recap to our audience, you can use this product to buy a home, move up, You don't have to be a first-time home buyer. You don't have to have certain criterion. You do have to qualify to make the payment, right? The ability to repay, but it should allow you a different way of looking at leverage. And if you talk to your financial planner or your trusted advisors, this is a better way of doing things because you save money today and there is opportunity cost on that money today. And we don't know what the exact future is going to hold, right? Hopefully you gain 8% a year of appreciation. But even if you don't, you've been saving money today. And maybe those alternative ways you've either paid down your current debt or invested in other things helps offset that also. So you may be ironically gaining appreciation in several categories, or eliminating some of your higher debt exposure that you have. Maybe you have a huge credit card and you want to pay it off, whatever it might be. So this is very, very powerful. And I can see this being something that really picks up across the country and helps families make better decisions around wealth. And that's the point of our show. Know Before You Owe is to make sure you have great information from professionals like yourself to make great decisions for you. And it's about you. It's not about someone else. So I appreciate you, Sanjay, for being on. We'll make sure that we put your link on how to apply, how to get more information. And thank you again for being on, Sanjay. It's awesome to see Steadworth and how you've taken years of your knowledge and turned it into a really cool product that can benefit everybody. So
yeah, I mean, we've actually done, a transaction with an employer, and now we're looking at ways to sort of roll out the retail model to sort of a broader audience. So everything's in place and we're just sort of thinking through that, but happy to talk with anybody that wants to learn more.
Awesome. Well, thanks for being on our show, Know Before You Owe. Please like, subscribe, and follow us. And Sanjay, awesome to see you, my friend. Thanks again for being on, and I'll see you real soon.
All right. Awesome. Thanks.